you very much, Doug. Thank you very much, Brookings, for inviting me here today. I'm very grateful for the opportunity to give an a European Union perspective on this whole debate. I wanted to say a few words about where we are in the European Union at the moment on the implementation on our new insurance framework, and then talk a little bit about EU-US issues and finally the global standards as well, and I'll keep it brief. As you're probably aware, the EU is in the process of implementing a huge revision of its complete insurance framework called Solvency II. To be clear, this project actually started before the financial crisis, but has of course benefited, in inverted commas, from the experience of the financial crisis. And we think that with this new framework that is being implemented now, we will have a robust, modern, up-to-date framework for the insurance industry. Only last week did we publish a large number of implementing standards that will deal with things like valuation of assets, methodology, calibration, securitization, and all that. So we're in the middle of this process, but the new system will go live on the 1st of January 2016. Under Solvency II, there are very clear provisions on how third country, what we call third country, non-EU actors can keep access to the EU marketplace. The first very clear message is the EU is an open market, and we value the engagement of insurance companies from all around the world in the EU. Reinsurers can provide directly service inside the European Union. Direct insurers need to establish a branch or a subsidiary depending on what kind of business they do. And it is the European Union, triggered by the European Commission, that decides on whether third countries' jurisdictions outside the European Union are considered equivalent to our regulatory regime. Now, as I said, in general, the regime is open anyway. You can do business based on branches, subsidiaries. But if the jurisdictions where you actually come from is considered equivalent to the framework that Solvency II puts in place, lots of the requirements under Solvency II are not directly implemented. It means that you can actually operate under home country supervision, which is a concept that is very typical for the European Union. The whole integration of the European Union's internal market to a large degree is based on that concept. I know it's sometimes a bit foreign or a bit strange maybe to a US audience. We have lots of discussions also with other regulators in the US, in the securities area, in other areas, this whole issue of reliance deference to another framework. But we think it's something that is very helpful in the international context, because given that we are operating in very international businesses, in very international segments of markets, we always have different frameworks. We always have international frameworks, different jurisdictions having different frameworks, and it is important to find a way to make these different frameworks work together, chime. And I think this way of relying on each other